When I started investing, like I said, I saw it as more of a hobby. And I think that for me, being an engineer, particularly like an aerospace engineer, it was really a part of my identity. It's like that's who I am. And one thing that I had to like go through was realize like there's a lot more to your identity than just what you do to make money.
Hello, everyone. Welcome to another segment of Ask the Multifamily Expert. Like I always say, this is an episode for you to come and ask the experts direct questions because typically these people, you might not have access to them. I have someone from the microblanks community. He's a coach on the microblanks community. And for you to be in the microblanks community, it has to be paid for. So you have access to ask him any question you want to right now without having any embargo, without having to pay for it. This is an opportunity for you to ask something and continue with your journey. This really helped me in my journey in multifamily, the ability for me to go online, get educated on YouTube, freebies, like I said, because I did not have the money to get a mentorship group and all that. So I decided that we're going to do this to encourage people in their journey. Today I have with me Jonathan Nichols. He's going to give us a brief summary about himself. He's going to tell us who he is. But before then, I want to discuss about what we'll be talking about today. Today, we'll be talking mainly about acquisition. Some of us are in our early journey. We are looking for deals, talking to brokers, talking to property managers, doing all sorts, underwriting and all that. Jonathan has done this. He's been doing it for quite a while now, and he has the expertise to direct you and guide you. The idea is for you not to make the mistakes that we made at the beginning, to make your journey streamlined with the right information from people like Jonathan. So Jonathan, good to have you. Can you just tell us briefly, who is Jonathan?
Yeah, absolutely. Thanks for having me, Bibi. I'm excited to be here. Appreciate the invite. So my name's Jonathan Nichols. My wife, Paula, and I became accidental real estate investors about 7 years ago, shortly after we got married. And we started out investing in real estate as just a hobby, something we were going to do on the side. Some couples go play golf, some go do other things. We wanted to invest in real estate, and we figured, maybe it could be a hobby that paid us instead of us having to pay for it. And so off we went. And one day my wife came home and informed me that what we needed to do as our first investment was house hack a fourplex, which simply means move to a fourplex and renovate it while we live there. And so that was actually my first real estate investment going back about 6 years ago. Since then, it's gone up in value a lot and have been investing ever since. And so about 4 or 5 years ago, we switched from the residential investing world over to commercial multifamily, primarily one because of economies of scale. I'm sure if you've followed BB for a while, you know about a lot of the advantages that multifamily offers. Also because we felt like it was better suited to our abilities. So my background was working as an aerospace engineer. My wife's background was working as a consultant. And so we felt like our professional skill sets fit better in the world of multifamily investing than, trying to be a handyman or landlord in the single family investing world. So since then, we've done a number of different projects. We focus on Texas and Oklahoma as our markets, and we buy a lot of properties in tertiary markets in these two states that have done extremely well over the last few years. We live in the Dallas-Fort Worth area and are obviously both full-time investors. So that's kind of the short and sweet.
How is it possible for an aerospace engineer to leave that kind of good paying job and decide to just hand that over and continue with multifamily? How is that possible?
That's a great question. And honestly, most of it, like many things in investing, is really a mindset shift. And so, when I started investing, like I said, I saw it as more of a hobby. And I think that for me, being an engineer, particularly like an aerospace engineer, it was really a part of my identity. It's like that's who I am. And one thing that I had to go through was realize like there's a lot more to your identity than just what you do to make money, right? Like there's so many other things in terms of who you are, what your character is, how you help people, what your interests are, etc. And I think that sometimes, particularly in like American culture, we revolve our identity around our job or occupation and what makes money. Whereas sometimes in many parts of the world, it's more about your family or where you come from or what you enjoy doing. And so it just took a mindset shift of like being an aerospace engineer is not the only component of who I am, and there's more to it than that. And once I realized that, it opened up a lot of doors for me in the sense of like there's other ways to make income and use my time more effectively than trading my time for money as an engineer. And that's what brought me down, the path of passive investing, of real estate, of being a business owner, and really allowed me to take that mental step forward out of the W-2 world.
Yeah, so I know you are currently on, let me say, two deals at this moment. So I want you to walk us through the acquisition process. I know you've done this several times. Just give us a typical Jonathan's process before you put a deal under contract and close on it. What do you do? How do you source for your markets? Because you just told us you are in the Dallas and Oklahoma market. Why Dallas and Oklahoma market?
First of all, the answer of why those markets, they're both strong markets. Oklahoma tends to be slightly more cash flow oriented. Texas tends to be a little more appreciation based, just in general. They're both good markets, though. We've had success in both of them. Frankly, though, the reason that we've chosen those markets is one, I'm very familiar with them. My family's originally from Oklahoma City, but I grew up mostly in Texas. And so a lot of the markets where we invest, like Tulsa, Oklahoma City, Lubbock, College Station, like these are places that I've lived and know very well. And so I think that plays a lot into being an investor because, like, when I see a property's location, I'm probably familiar with where it's at in the city and whether or not I'm interested in buying there. And then let's see the other side, acquisition process. We could probably talk for an hour about that, but I think the first thing that I would mention that I did not understand when I got into this business is it's a lot more than just being good with numbers. It's very much a relationship business. And so, 95+% of large multifamily deals are traded through brokers, and your relationship with the brokers is what allows you to have access to those good deals. And so a lot of my time is actually spent developing and maintaining those relationships, particularly in markets with brokers who have properties in markets and the specific property types that I'm interested in. And then beyond that, it's really being an expert in your field. And so one thing about this industry is it's very dynamic. And so, we don't look at deals the same way today that we did a year ago, and certainly not the same way we did 3 years ago, right? The debt that's available is different. The pricing is different. The, competitive terms needed to win deals are different. And so you have to really stay on top of the industry to be competitive as you're competing for deals. But if you do your homework, if you know what you're looking for, then I think particularly at this stage in the economy and this year, like there's a lot of opportunities out there to find.
Yes, based on what you said, there's something that recently happened to me with a relationship with a broker. I got a deal under contract, and for some reasons, good reasons, I refused to go forward, and the broker was so upset. So my question to you is, how do you keep that good relationship with the broker and still keep your standard intact? If you don't have to go forward with deals from a particular broker, how do you still keep that relationship and ensure that everything is still good?
Yeah, that's a very sticky question. I think that first of all, I always prioritize my integrity and relationship with my investors over that with the brokers, even though I do try to maintain high level relationships with the brokers that I work with. I think there's kind of two things. One is I try to come to the table prepared as I'm looking at deals. And so when I'm going and touring the deal, when I'm putting an LOI in on the deal, I ask a lot of questions about the property's condition. And so I can't know everything until we go in and do due diligence, but I at least ask the right questions and give them the opportunity, they and the sellers team, to disclose any information that we should be considering as we're placing our offer. And so I think that if you're asking questions about the roofs and the sewer lines and all those key physical things, and obviously the financials of the property as well, then when you go into that due diligence phase, if you find something that does not align with what you were told, then in a real sense, it's really back on the seller's team. Like they had an opportunity to disclose that. And as a part of their business strategy, they chose not to. Not saying it's right, not saying it's wrong, just saying they chose not to disclose that. And so, because I found that new information, I have the right to go back and talk to them about, what the deal's worth or what we need to negotiate out. But I try to get that information and do all my due diligence and find that out up front if possible so that, I'm not having to retrade or back out of a deal. That said, I too, and I would tell you that most multifamily buyers have had to exit a contract or an LOI at one time or another. And typically it's due to situations like this. And, the way I explain it to the brokers is like, we are every bit as committed on this deal as we have been from the beginning, but this is new information that was not disclosed to us up front like it should have been. And so, if that puts you or your investors in jeopardy of hitting what it is that you need to for your investment, then that's really the only choice that you have. And the good brokers will understand that and work with you. The ones who don't, frankly, they may not be the best brokers to work with. You may need to find someone else that has a better understanding of that. Because if you've done all your homework up front, then there's really nothing more you can do. It's not like a game of hide and go seek.
Exactly. So, in other words, it's not every broker that is for you, with what you're saying. When you're conducting your due diligence for your acquisition, what is the red line for you? At what point do you say, I'm done, I can't move forward any longer?
Yeah, it's interesting. I feel like there's when we go into the due diligence phase, in my mind, one of three things happens. You kind of have an idea of where you think the property's at in terms of condition and financial performance. And then as you start to uncover more detailed information, the deal either starts to look sweeter or it starts to look worse. And if it starts to look sweeter, that's when you can wind up with home run deals. And we've had that happen several times on deals that we've purchased where it wound up looking better. Sometimes, though, it starts looking worse. And that's where it gets sticky because as you start getting to the lower end of like the returns you would want to offer to investors, you have to make a decision about like, is there too much risk to move forward on this deal? And then sometimes you have the third situation where you uncover something so bad, if you will, on the property that like it's a pretty black and white decision that you need to exit. And so that's not always an easy position to be in, but it's a very simple choice that like, hey, this is what I have to do.
So can you just pinpoint those kind of things that you had to confront that, because I know you've done so many deals and you've decided to go on with some and not. So which of them, why did you back out from those particular deals? What was the things that made you turn back? Was it the roof? Was it the plumbing? Was it a lot of discrepancies with the financials and all that? So which of them was it for you?
I can give you two examples. We've only ever had to exit one contract before, so I can tell you a little bit about that. And then also we had one LOI that we had to exit. The LOI was actually our first deal that we ever were going to do as multifamily investors. So we were new, we were inexperienced. And long story short, there were some other income items that were listed on the property, specifically through the laundry center and some other items that were being mislabeled by the property manager. Like their accounting team was not accurately portraying that on the financials. And so the seller gave us access to the raw financials, specifically the bank statements, before we went under contract. And that time we realized that basically they were exaggerating the income on the other income by as much as 10 times of what it really was. Enough that like as an experienced investor now, I would have figured it out much sooner, but at that time I just didn't know. And so we went back, we were still willing to buy the deal, but just at a slightly lower price. And yeah, the seller was unwilling to work with us on that, which was a shame. And so we had to exit that deal. But ironically, they fired their property manager for, fraudulent accounting like a couple weeks later. So I guess we helped them in that sense. So that was one. We had another one, the one we were under contract on. Some of the questions I'll always ask during the tour or during the time speaking with the broker before placing the offer is surrounding the physical condition of the property, like the roofs, the sewer lines, electrical, other plumbing items. And so we asked all these questions on a property and put it under contract. And long story short, the sewer lines under all the buildings across the entire property were shot. And so we verified it with 3 different plumbing companies that we trusted. And it was going to be a very significant amount of money to replace all this plumbing because it was directly under the buildings. And so once again, we made an offer, a counter offer to the seller, basically, hey, we'll still purchase it, but we need a discount to build or replace this because we weren't expecting it. And we did our homework and asked all the right questions up front, and we're told everything was good. And, once again, they were unfortunately not willing to work with us on it. So those would be examples of situations where, transactions don't work out.
I think that is typical with every definer and all that. We've had that kind of issues as well. For the last 9 months, we've done a lot of LOI. We've gone through the due diligence and we've never crossed out of the due diligence because it's either we are finding out discrepancies in the financials, in the expenses or in the income, and we are finding structural issues. We're finding out survey issues, the owner doing additional units without the right permits and all that. So too many things. And this is why due diligence is very important during your process. So I want to ask you this. What are the market trends? Because you're in the Dallas and Texas market. And I also heard you saying something about the tertiary market. For some people, not me, some people, if it's not the primary market, they don't do secondary, they don't do tertiary. Why did you decide to choose the tertiary market in a place like Texas or in a place like Oklahoma?
Yeah, that's a good question. And I get it a lot from both investors like at the limited partner level as well as the general partner level. And I would say the short answer is like we live in Dallas. We love Dallas. We do intend to be transacting deals here in this market. It's a great market. But my philosophy has been I would rather do an excellent deal in a good market than a mediocre deal in an excellent market, So I feel like if you're here in Dallas and you're buying a deal where it's like I'm banking on appreciation and it's not cash flowing, it's not working out well, you're not getting it at some discounted basis, you're really counting on the market bolstering your investment. And I'm not a fan of that. I have limited partner deals, not general partner, but limited partner deals that I've invested in all three of the major cities in Texas. All of our general partner deals in tertiary markets are currently doing distributions. And so, I think it's easy to be like, well, say a Tulsa or a Lubbock or whatever is not as strong as Dallas, which is a fact. Yeah. But if you get the deal and you underwrite it appropriately, there's a lot of opportunities in those markets, particularly for investors who are interested in a balance between appreciation and cash flow.
Thank you for that. So as many people that are looking for opportunities, the tertiary and the secondary market can be an option for them, not just the primary market where we have a lot of competition going. So let's dive into raising capital. We've been experiencing a lot of challenges in raising capital. How do you secure financing for your multifamily deals?
Yeah, we're pretty traditional syndicators. So, we're going out and getting a loan, typically some type of agency loan, but not always, anywhere from, let's call it 70-ish% of the balance for the purchase price. And then the remaining 30% plus CapEx, we're taking from investors through the syndication model. And so we partner with other general partners and together raise that money from a group of limited partners for investments. And that's been our traditional multifamily model. So nothing super fancy or different, I would say. I don't know if that answers the question, but, pretty typical syndication model.
Before I continue with the capital raising, how do you structure your deal that ensures that everybody is participating? Because we get to see a system whereby the sponsor, someone like you, is taking the lead, and because everybody wants to be on Jonathan's team, so if Jonathan is doing it, that means everything is taken care of. How do you structure your deal for people not to be totally dependent on you, but everybody's working in the same synergy to fulfill that task? So what do you do? How do you structure it?
I would say it's a challenge. Like it's not easy, and it's harder today than what it used to be, in the sense that like we used to just have 3 or 4 of us, kind of my buddies, that would do this, and we could raise all the money, do all the tasks ourselves. And now general partnership teams are typically a little bit larger, and so keeping everyone active is a question that you have to answer on each deal, a deal by deal, partner by partner basis. I think a few things are kind of key of an active partner. One, I oftentimes will ask active partners to put some amount of the risk money on the deal. I think that if you have earnest money on a deal, that's a strong differentiator between being a limited partner as opposed to an active partner. And so that's one avenue revenue right up front. Sometimes signing on the loan is another way to show that individuals are active by having responsibility on the loan. And then beyond that, it starts to get kind of tricky with the asset management and stuff. My wife is our full-time asset manager, so she typically handles a lot of those responsibilities, but tries to dish out little tasks here and there for people to stay engaged. We encourage our, co-GPs, if you will, to be on asset management meetings and property management meetings and asking questions, obviously relaying information to investors. So it's just a matter of keeping people engaged. It's not an easy answer, but I think the important thing is that everyone has their hand in the pot and is doing something to move the project forward.
One very interesting question that just came in. How do you manage investors' expectations during periods of market volatility or economic uncertainty? We're in that period right now where I think sometime last year they were calling it pencils down. That is, many people, investors, were on the sideline, even up to this moment. How are you managing those investors' expectation and flipping them to become your investors? What are you doing differently?
Person who asked the questions, right? There are a lot of investors on the sideline now. I mean, the first thing, it's an overused saying, but the whole Warren Buffett about being greedy when everyone else is fearful and fearful when everyone else is greedy. One thing I'm telling my investors is like, if you were willing to invest in good deals with me in 2021, when the market was at an all-time high, you should definitely be ready to invest with me now when we're getting deals at a discount, which actively we are. We're finding deals that are heavily discounted from what they were 2 years ago. And my personal opinion is that they will not stay like that way forever or even necessarily a long time. And so I think there's a lot of opportunity people are missing out on if they don't consider investing now. There's also just a general, I think, cash problem. Like investors don't have as much cash in general now as what they did a couple years ago. And so it winds up meaning you need to open up your funnel for investors. You need more people to talk to in order to find those that do have funds readily available for investing. Because obviously, if someone still believes in investing, but they don't have any money, that doesn't help you. So you may just need a larger funnel as well. Those are the biggest things I'm telling investors right now. It is challenging, but I'll tell you, I personally am investing more in multifamily and real estate this year than what I ever have before. And so I'm extremely bullish on this asset class this year. And I think that, 3 years from now, we're going to look back and, wish we could have this year back. So
two more questions for you. One came in and one is from me. So what are the trends you see that will start shaping the deal sourcing in multifamily?
Wow, that's a hard question because I think that if I had answered it in any given year, then I would look back today and say I was wrong. So I'm very hesitant to say that. I'll say one trend that I hope we see coming out of this era. So, one thing I'll mention, I think this goes a little bit back to the last question, so you'll have to forgive me for pivoting back, but one decision we made back in 21 and 22 was to do all our deals with long-term fixed rate debt. So like today, when it comes to managing investor expectations, it's probably not as hard for me as it is for some sponsors because all the deals they're currently in are still cash flowing, they're still doing distributions, and we're not in a hurry to sell them. In other words, we can wait a year or two to sell those deals. And so, our projections are on target and we're not having a lot of major issues like some sponsors are with, bridge debts expiring or being too high or buying new rate caps. That definitely helps with the expectation. My hope for future market trends would be that people value what the property's currently worth. In other words, like the cash flow it makes after implementing a value add plan more than just appreciation or a low cap rate. So like I already mentioned, there's a lot of deals in the primary markets in Texas where like they're not really cash flowing. It's just, hey, yeah, we're buying this at a low cap rate, but as long as we can sell it at a very low cap rate, we're going to make money in 5 years. And I think we've all found that model does not work. And so hopefully investors will pay a little more attention to the financials. I think another thing that's going to come into play is the importance of asset management. A lot of sponsors have just not run their deals well because they didn't have to for a long time. And in today's world, you absolutely have to run your deals at a stellar level if you want to be making money for investors. And so Paul and I were actually members of an asset management mastermind. We joined a year ago. We're joining again for another year. I already mentioned that, her background, she worked for a developer, a large developer here in DFW as an asset manager, and now she does that full time. So we have a lot of emphasis in our company in just running deals well and just sticking to the fundamentals of, working with property managers, leasing, marketing, all those kinds of things that go into running a deal well. I think there was one more question on the end that maybe I missed.
Yes, I wanted to ask you, what advice would you give to someone new to sourcing multifamily deal? And before you say that, do you think AI is going to
Mm.
play a big role in deal sourcing within the next 1, 2 years, 3 years?
Yeah, that's a
Yeah.
that's a good question. I'm a big fan of Perry and Cashflow Portal. I think do you use Cashflow
Yes.
Portal as well? Okay. So, they have an AI tool they're developing for underwriting, which I've not seen or played with. There's also been a couple other people that have sent some stuff my way. Look, I think technology always is helping us to improve how we look at deals, right? So, like many years ago, there was not a Microsoft Excel to look at deals with, and people were doing commercial deals. Today,
Mhm.
Excel is a very powerful tool and you can do anything in it. And I assume AI will give us more tools. I think ultimately there's always an investor judgment component to looking at deals and analyzing deals that, technology is going to have a difficult, if not impossible, time replacing. We have criteria we look at. We can say, well, it needs this return or this or that. And certainly technology can help with that. But there are other intangibles that, we as humans are able to look at that I think will always be an important factor in underwriting deals. As far as new people in multifamily, it's probably hard to believe. I think this is a great time to get involved. My advice would be one, just do something this year. There's great deals, they're on sale, but I would say don't bite off more than you can chew. It's hard to raise capital now. It's hard to get deals done. And so, there's nothing shameful about starting with something a little bit smaller and then stepping your way up. So, try not to get in over your head, but keep moving forward would kind of probably be my advice.
I'm really enjoying this conversation with you. And the thing is, we've not even spoken about all the questions that we have, and I really enjoyed it. And maybe because acquisition is one of my sweet spots in multifamily, so I was just enjoying everything that you're saying. In a recap of what you said, in terms of getting a deal under contract, I took this from you. Try and work towards your ability. Don't overchew. Don't take too much than you can bite. Ask brokers some questions even before you venture into the deal and all that. And be open-minded to your investors and all that. Thank you so much, Jonathan, for this beautiful time. We had the opportunity to learn your acquisition process. And we also learned that primary market might not just be the ultimate solution to your multifamily investment. You might want to look at secondary and tertiary market. I'm currently in the tertiary market for my PA deals, and they are super fantastic. The returns there are phenomenal, but getting people to understand and fall in line, I think has been the most challenge for us. When you're talking about a tertiary market or a secondary market, everyone wants to be in Dallas or Houston or San Antonio or North Carolina. Everyone wants to be in those kind of markets and all that. So it's really good to hear from an operator that is really in those markets and doing so well in them. Would you like to give any takeaways to the viewers out there? What is your last word to them? After that, I'll need you to also tell us what exactly you're doing now and how people can connect with you.
Yeah, absolutely. I mean, I think kind of my parting words in real estate or multifamily is always, get in the game and get started. It's been a life-changing journey for me. 6, 7 years ago, I was in a cubicle, making a pretty average salary as an engineer. And today, whatever you want to call financially free, but I have my own business, have flexibility of schedule. It's not easy. There's a lot of challenges, but it's very rewarding. And so whether you want to get involved as a general partner and run your own multifamily business or as a limited partner and invest and passively enjoy it, just get involved in some way or another that, best fits your lifestyle. As far as getting in contact with us, you can see our company's name is Apogee Capital. I think our website's there. Feel free to look us up. I'm also really active on LinkedIn. That's an easy way to get a hold of me, or you can reach out to BB and I'm sure she can put you in touch with me as well. So happy to chat anytime.
Thank you so much, Jonathan, for making out the time to be with us. I really enjoyed it, and I'm sure we'll carry a conversation outside this and discuss business, further collaboration and relationship afterwards. Thank you all and have a wonderful day.